Welcome to SB Talks. Today is Tuesday, February 24th. My name is Vincent O'Neill and I am joined as ever by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will be discussing the US Supreme Court ruling 6-3 against Trump's IEEPA tariffs, US Q4 GDP and the shutdown drag, as well as AI's continuation to disrupt software stocks and parts of the private credit market. Welcome to all our listeners. We discussed on our last episode the Supreme Court shadow hanging over a cohort of the Trump tariffs, that's specifically the IEEPA tariffs, the International Economic Emergency Powers Act tariffs. The Supreme Court has ruled in recent days. It's come down 6-3 against the administration, breaking a hot streak that they had on Supreme Court rulings, but to you, not necessarily a surprise.
No, the general view and the view in markets was that these tariffs would probably get overturned in the Supreme Court. The view was that IEEPA does give the president powers to regulate commerce, fairly broad, but it does not specifically say that he has the right to impose taxes or tariffs. Tariffs are a form of tax. Only Congress has the power to introduce new taxes or tariffs. So it was always a stretch.
He's got straight back out there tariffing some new ones under Section 122 of the Trade Act.
Well, even those are probably illegal.
He's got 150 days to get them passed.
That's right. So Section 122, which allows for a maximum 15% tariff for a maximum period of 150 days, so through to July 24th, unless they're extended by Congress, which is highly unlikely. They're meant to be reserved for a large and serious balance of payments deficit. That was introduced in 1974 when the US had a fixed exchange rate, and they did actually have possibility of balance of payments deficits. But now with floating exchange rates, basically any trade deficit is offset by an inflow of capital from the rest of the world. So that mathematically, those sort of two things net out. So the US actually...
You've been much too logical here, Nick. Yeah.
But mathematically, a trade deficit and a balance of payments deficit are two very different things. Trade deficit, obviously, import goods, but then there's also services, which are not included in the goods trade deficit, which the US has a massive goods trades deficit, but they're a major exporter of services to the rest of the world through some of their tech companies and things like that. And then that has to be offset by inflows of foreign capital to fund that deficit. And the US is a massive importer of capital because people want to buy US dollar assets.
And US government bonds.
US government bonds, tech company shares, you name it. So the two things sort of offset each other. So they don't have a massive balance of payments deficit. So under Section 122, those tariffs are probably illegal, but no one's going to probably take them to court because they only last for 150 days.
It's a band-aid. So maybe we'd step back from the whole thing because we knew the IEEPA tariffs were only a certain component of the broader tariff regime we had outside of that, some of the sector-specific tariffs. How do you, I guess, step back from the whole thing and reflect what is the picture as we sit today? And one thing that the Supreme Court very much did not rule on was what about the refunds?
Well, that's right. So there are estimates that around $175 billion has been collected since these tariffs were introduced in April. The court was silent on refunds. It will probably have to go back to court, probably to a lower court, to the one that made the initial decision. There's the Court of International Trade, but these things will take time. Likely there will be refunds. Whether people have to fill out paperwork to get them back or whether they're automatically paid back, that will remain to be seen. Apparently, I understand there's an active market of people trading these refund claims, which were at one point trading for 10 cents in the dollar. So maybe they're a little higher than that now, but it looks like there will be refunds. It's just going to be a messy process. And it's unfortunate that the Supreme Court didn't actually make a determination on that
just
to make
make
everyone's lives easier. That $175 billion was about 10% of the US budget deficit last year. So it was quite a big amount of money. The bond market really didn't react to that too much. I think a lot of this has been priced in. But what it does do is it creates a huge level of additional uncertainty. We had a bit more certainty even with the IEEPA tariffs. Now we're going to have to see what comes. So there's two other sections of the sort of Trade Act. There's Section 301, which is reserved for countries which have unfair trade practices. So, government subsidies, labour, forced labour, things like that.
And we know that they'd like to stretch that interpretation of unfair trade practices to the limit.
Yeah, well, they did use those against China. Trump and Biden have used those against China previously, but there's a whole process around that where you have to have public inquiries, and that will take time. So whether that can be done in the next 150 days remains to be seen.
And whether they choose to follow that process.
And you have to do it for each country, of course. And then there's the other section, 232, which are sector-specific. So things like steel, aluminium, airplane parts, and they're for national security reasons. And they're not country-specific. So it's just a lot more complicated. The president does have those powers. The US Trade Representative has those powers to run those inquiries and to impose tariffs. But more complicated. That said, there's a precedent. Trump did that in his first term.
As an investor, how do you feel about all this?
Well, no one likes uncertainty, and I think it's a bit of a rewind to April because people go, okay, well, we don't know what we're going to be dealing with. Importers won't know what they're dealing. They've got the uncertainty of whether they can get their refunds, and then what does the new regime look like beyond July? So it's very uncertain. And then also, for countries like Australia, we actually have a trade surplus. We buy more US goods than we sell to the US, as does the UK, and we're worse off. We had a 10% tariff, now we have a 15% tariff for the next 150 days.
So there's some other deal done.
Whereas China and Vietnam and all these other countries are miles ahead.
Materially better.
So there's winners and losers.
I think it's also fair to say when we go back to last April, there was a pretty significant market reaction to this, but over the passage of weeks and certainly months, markets have become a little bit more fatigued and potentially even somewhat dismissive of the evolving situation.
Well, that's right. And then there's all these trade deals that Trump did. Remember, he did one with the EU and India and Japan and Korea, a lot of countries. And there's a big question mark over whether they're still valid, whether they're binding. The EU's currently sort of saying, let's not ratify this trade deal. Let's see what happens. So it's just more uncertainty. And I guess Trump's bargaining powers are not as strong as they were when he was trying to use IEEPA.
Yeah, no, that's a very good point. It definitely does reduce some of his leverage in those negotiations. Staying stateside, we had US GDP figures announced for Q4 in the last week, down at 1.4%, down from 4.4 in Q3, but a material shutdown drag in those numbers.
Yeah, so the government spending was a big part of the shortfall there. Due to the shutdown, so that will obviously reverse in the first quarter of this year. If you look at sort of consumer spending, which is sort of the engine of the US economy, accounting for I think 60 or 70% of GDP, that was not too bad. That grew at a 2.4% annualized pace. I think the result was, market kind of shrugged it off a little bit. A bit of noise in there, as there has been with everything to do with the shutdown, including, inflation, labour market data. It was interesting, though, if you kind of dug into the detail, US consumers have been definitely spending more than they've been earning. So running down their savings or borrowing. So one wonders how sustainable that is, going forward, whether, we might start to see some cracks in the US consumer.
And the bulletproof US consumer confidence. Yeah. So I guess looking through those numbers and really probably into the next quarter and wanting to see that probably normalize out.
Yeah. There was also the core PCE inflation print that we got at the same time. That's the Fed's preferred measure of inflation. and that for the year to December was 3%. So really, we haven't seen a lot of progress in deflation or disinflation in 2025. I think that was actually higher than at the start of the year. So, economy doing okay, inflation still too high. We had the labour market figures the week before that showed unemployment at 4.3%, down from 4.4%. So those cracks in the labour market, not really evident. So the Fed, hard to see them justifying rate cuts from here. They are priced in for the second half of this year, but
under the new administration.
Yeah, well, if we get a new Fed chair in May, who knows whether that will happen? But
not really a basis to be making cuts, given where inflation is at, given the sort of broader health of the economy and the uncertainty that you talked to before.
Yeah.
You've talked in the last couple of recordings about your broader optimism on the outlook. Through this tariff things, feels like we're dragged back into it a little bit. Some of the question marks over the numbers in the US economy. Does it change your outlook at all? Your optimism?
No, I don't think so. We haven't seen any evidence that the views that I expressed, which I termed cautiously optimistic, I think they still hold from what we've seen. Yeah, there's as I said, fractionally more uncertainty about the trade environment that will probably get sorted over the next few months.
Frustrating as much as anything else.
Yeah, but despite all the trade noise last year from April through till August, whenever those tariffs eventually came into effect, the economy still held up. So I don't see that this will derail that story.
Well, I think businesses had to make a decision last year. Do we just put everything on hold, or we just hold our breath and go for it? And they went for it by and large, and that's probably not going to change into this year, despite sort of the re-emergence of some of that uncertainty.
That's right.
On our last episode, you talked about this SaaS-apocalypse, a bit of this tech rotation. That theme continued.
Yeah, so particularly in the last few days, we've seen that sort of get more attention. It's really, there's been a few sort of developments with AI tools, and a Substack article last night that kind of questioned, who are going to be the AI losers? So we kind of know who the AI winners are, companies like NVIDIA, but now there's this sort of, this company or this sector is a loser. So software was the first one to kind of get smacked.
Feel the heat.
But even other sectors like trucking and even our own industry has come under a bit of pressure as people say, the economic moats that have protected these industries maybe don't hold in the world of AI. AI can do a lot of that stuff, or create software, or create efficiencies. And so a lot of sectors have been hurt, but software is probably the poster child for that. So I think the S&P software and services subsector is down something like 25% year to date. Some big names, including Microsoft, is down quite a lot. It's in bear market territory, and that's also started to flow into other sort of sectors. So there was a bit of a noise last year about private credit, for example. Now, private credit has been a big lender to a lot of software companies that are owned by private equity firms.
The cockroaches hit the headlines last year.
Yeah, so it was cockroaches in First Brands, which was a car parts company, but now with everything going on with software, it's like, who's been lending to software companies,
particularly in the private markets?
In private markets, so Blue Owl is sort of a company that does have private credit funds, and they got hit with redemptions. So a lot of these private credit funds cap redemptions at 5% per quarter, and they got hit with well in excess of that, and then said, we can't give you your money back. And of course that it's like a bank run. People then say, I want my money back. If you're telling me you can't give it back, I want it back. So a lot of those, so Blue Owl in particular has been impacted. They were able to sell a whole pile of their private credit loans for $1.4 billion to try and get some immediate cash inflow, and they sold those at at just a modest discount to par value, so 99.7, I think.
So it's raised the question: have they sold their better assets and holding the ones with more concerns?
Maybe they did.
How does that make you think about private credit exposures and portfolios more broadly, and particularly some of the positions that we might have?
Well, I think the firms that we have, we've been in contact with them, or they've proactively reached out to us as a result of this, and said, look, our software-related exposures are in one case less than 5% of our portfolio. So the firms we have do not have a lot of exposure to these software names, and where they do, they say the companies have bigger moats. They're not just a single piece of code that can be replaced by AI overnight. They're deeply embedded in their corporate customers sort of
huge data advantage sitting
workflow. Yeah, so they feel fairly confident about those exposures. So we're not too worried. But I think there's always that possibility that what happens in one private credit firm infects the whole industry, and then people start to get worried about it as a broader sector, and you get maybe excess redemptions that the industry might struggle to process.
And I think it's probably behind this all is a broader theme that AI is a disruptor. Okay, we know that it's well flagged, but how that's going to manifest itself and how it's going to pop up in financial markets and in the economy in different ways is yet to be seen, and it will probably have flashpoints potentially with reactions and overreactions. So I guess we just want to stay fairly well diversified and fairly prudently invested through this.
Yeah, and on the way up, a lot of these software companies did extremely well, and a lot of our active equity managers maybe were more cautious on them, or they had a valuation discipline. They mightn't have fully participated in that rally. And so, this may be an opportunity for them to shine in a relative sense, because they have maybe more defensive companies. Healthcare is a sector that's actually done quite well in the last few days because it's seen as more resilient, less likely to be disrupted by AI. Consumer staples, same thing. So to the extent that our fund managers have exposure to those kind of stocks that are a bit more boring, hopefully that shines.
That gives them an opportunity to play their part. A lot to get through there, Nick. Very comprehensively done. Thank you as always. And thank you to all our listeners.